Welcome to the Deep Dive, your shortcut to being well-informed. We pull out the most important nuggets from the latest insights.
And today, we're diving into Simply Good Foods Company, specifically their third quarter results for fiscal 2025. That's the period ending May 31st.
Right. And this isn't just, any snack company. They're right at the heart of this big shift in consumer habits towards healthier stuff.
Exactly. Protein-packed, low sugar.
Yeah.
It's a major trend. And their results give us a really good look at their strategy and how the market's moving.
Okay, so let's jump right in. The headline numbers first.
Sure. Net sales were up 13.8% compared to last year. Came in at $381 million.
That sounds pretty strong. Was that all organic growth?
Well, a big chunk, about 10%, came from the Owen acquisition, which is still relatively new. But they did have solid organic growth, too, about 3.8%.
And Quest was the big driver there, right?
Absolutely. Quest was up 15% in Q3. Yeah, really strong performance.
Okay. What about profitability? Adjusted EBITDA?
Adjusted EBITDA grew 2.8%, reaching $73.9 million. And adjusted diluted EPS was 51 cents. That's up just a penny from 17.50 cents last year.
Okay. A slight increase on the EPS front.
Yeah. And what's interesting is how they're handling their finances alongside this. I mean, cash flow is really strong.
Oh, yeah.
Yeah, $133 million from operations so far this fiscal year. And their debt levels are, well, incredibly low.
How low are we talking?
We're talking about 0.5 times net debt to their trailing 12-month adjusted EBITDA. Super low.
Wow. So that Owen acquisition debt?
Mostly gone. They borrowed $250 million for it, and they've already paid back $240 million of that.
Impressive. And are they returning cash to shareholders too?
They are. Bought back $24 million in stock this quarter alone, and they still have nearly $50 million left on their authorization. So a really solid balance sheet picture.
Okay, strong balance sheet, good cash flow. But there must have been some pressures, right? You mentioned EPS was only up slightly.
Right. The main pressure point was gross margin. It actually dropped by 350 basis points.
3.5%.
Yeah, down to 36.4%. And the main culprits were input costs. Cocoa and whey, especially, got really expensive.
Key ingredients for them, I imagine.
Definitely. And while they did push through some price increases and found some efficiencies, it just wasn't enough to fully offset those higher costs.
Got it. So, okay, let's look beyond the numbers then. What's the underlying story here? The category itself seems really hot.
Oh, absolutely. The whole nutritional snacking space is booming. Double-digit growth. It's gone completely mainstream.
People wanting high protein, low sugar, low carb.
Exactly that. It's a generational shift, really. And Simply Good Foods is positioned right in the middle of it with three pretty distinct brands.
So let's break those down. Starting with Quest, it seems like the powerhouse.
It really is. It's about 60% of their total sales now. And like we said, double-digit growth again this quarter in both retail takeaway and net sales. Consumption up 11%.
Household penetration increasing too.
Yep, up to 18.3%. Their whole strategy is about, disruptive innovation, getting products into more stores, and just building that brand awareness.
And you mentioned something earlier about salty snacks within Quest.
Yeah, that's one of the really exciting parts. The Quest Salty Snacks platform grew 31% in retail takeaway. It's huge.
31%. Wow.
I know. And it's actually on pace to become Quest's biggest platform overall. Retailers are loving it too, giving them more shelf space, even putting them outside the usual snack aisle in some big stores.
That's a great sign. What about the original Quest bars? Are they still relevant?
They are. They actually returned to growth this quarter, up 3%, mainly driven by their crispy line and a new launch, the Overload bars.
Overload. How are those doing?
Really well, apparently. Strong initial distribution, good feedback, high reviews online, especially Amazon. So yeah, the bar business is picking up again.
And they have shapes too, right?
They do. They launched a new 45-gram Quest milkshake. It's still early days, building distribution, getting the word out, but progress is positive. And they're hinting at more innovation coming for their bake shop platform too. Lots happening with Quest.
Okay, so Quest is firing on all cylinders, but Atkins is a different story this quarter, wasn't it?
Yeah, Atkins faced some headwinds. Consumption was down 13% in Q3.
Was that a surprise?
Not really. It was actually in line with what they predicted. It boils down to a couple of things. Losing some distribution at a key retailer, and also lapping some really big promotional events from last year that just didn't repeat.
So what's the plan with Atkins then? Are they just letting it decline?
No, it's more strategic than that. They're actively trying to reshape the Atkins business, make it more focused and sustainable.
They're already doing that.
By optimizing the product assortment. Basically getting rid of the slower moving SKUs, that long tail of products that don't sell as well.
Cutting the fat, so to speak.
Exactly. And it's important to note their core Atkins products, the main sellers, actually perform really well, better than the category average in terms of how fast they sell. And online, where shelf space isn't an issue, Atkins e-commerce is growing nicely.
Interesting. So it's really about shelf space optimization at retail.
That's a big part of it. They're working with retailers to rebalance the shelf, basically trading out some of those slower Atkins SKUs to make more room for the faster-growing Quest and OWYN products.
So even though Atkins might keep showing double-digit declines into next year because of these cuts?
Right, but if you strip out the impact of those specific distribution losses, management says the underlying brand performance is ostensibly flat.
Ostensibly flat. But is there a risk in cutting back like that? Could they lose loyal Atkins customers?
That's always a consideration, yeah. But their research suggests Atkins still plays a key role for people focused on weight management.
Even with the new GLP-1 drugs out there?
Apparently so. It seems there's still a dedicated user base. The bet is that focusing Atkins on its strengths and highest velocity items will make the whole portfolio stronger and more profitable, even if the top line for Atkins itself shrinks for a bit.
Okay, a calculated move then.
Seems like it.
All right, let's pivot to the third brand, OWYN. That one seems to be doing really well too.
Absolutely. OWYN is another growth engine. Retail takeaway was up 24% in Q3.
24%.
Yeah, really strong across the board. Ready-to-drink shakes grew over 20%, and they picked up significant distribution gains, about 18%, from the spring shelf resets at retailers.
Was the growth slower than before, though? I thought I heard something about that.
It was slower than the first half, but that was totally expected. They were just lapping some huge wins from the year before. The key takeaway is that OWYN still has a really long runway for growth.
Why is that?
Well, the product velocities are strong, it brings new shoppers to the category, and its distribution is still relatively low compared to competitors. Its ACV is in the low 60s.
Meaning it's only in about 60-something% of stores.
Right. Leading brands are often 20 or 30 points higher than that. So lots of room to get into more stores. Plus, its whole positioning, clean label, plant-based, really hits the mark with current consumer trends. It fits perfectly in the portfolio.
Okay, so strong growth from Quest and OWYN, offsetting the strategic pullback in Atkins. What about the outlook? You mentioned those margin pressures. Are they expecting those to continue?
They are, unfortunately. They flagged ongoing inflation and also tariffs impacting gross margins again in Q4 and probably into the first half of next fiscal year, fiscal 2026.
So how are they fighting back against that?
They're really leaning into productivity improvements and cost management efforts, stepping those up significantly. And they're also taking some selective price increases, like on Atkins shakes.
When do they expect those actions to really pay off?
They're saying the full benefits should materialize over the next 12 to 18 months. It takes time for these things to flow through.
And what does that mean for the full year guidance? Did they update that?
They did. For the full fiscal year 2025, they now expect total net sales to be up 8.5% to 9.5%, and adjusted EBITDA growth between 4% and 5%.
And the goal for gross margin?
Their target is to get back into the high 30s. They see that level as crucial for funding all the innovation and brand building they want to do.
Makes sense. Is that 12, 18-month timeline for fixing margins realistic, though, given how volatile things can be?
It's definitely ambitious, but they seem confident. They point to their flexible supply chain and their track record of being pretty agile. Plus, their capital allocation plan gives them options.
Right. You mentioned M&A was a priority.
Top priority, actually. They explicitly said M&A first and even mentioned having interesting things in the pipeline. Then debt pay down, which they've clearly shown they can do, and finally share buybacks. That super strong balance sheet gives them a lot of flexibility.
Any other potential headwinds? What about those new food additive regulations we're hearing about?
They address that too. They feel they're actually much better insulated than a lot of their peers. They said the impact on their portfolio is very small, with no major cost implications. OWYN's clean label status really helps there too.
Okay, good to hear. So pulling it all together for you listening, the big picture seems to be the strength of Quest and OWYN. Together, they're like 70% of the business now.
Exactly. Their double-digit growth is really powering the whole company forward, even while they're strategically trimming back Atkins. A real portfolio management story.
So from an investment angle?
Well, you've got management tackling cost issues head on with productivity and pricing. You have that rock-solid balance sheet and a clear plan for using your cash, prioritizing growth through M&A. And The whole nutritional snacking trend is just a massive tailwind. It points towards sustainable growth, assuming they execute well.
And management certainly sounds confident in their ability to do that. They keep talking about their agile culture, their supply chain flexibility, their team.
Yeah, they believe they can keep innovating, keep expanding distribution, keep building those brands, and ultimately create shareholder value.
All right. That sounds like a good place to transition to our more speculative segment.
It is indeed time for our This Is Not Financial Advice segment. You know the drill.
Yeah.
We pitch a plausible, if maybe slightly outrageous, trade idea analyst style.
Let's hear it.
Okay, so thesis. Go aggressively long, Simply Good Foods, ticker SGF. Here's why. That balance sheet is pristine, right? 0.5x net debt to EBITDA. They're generating tons of cash. And they've explicitly said M&A is priority number one, hinting at things in the pipeline.
Okay. So you think a deal is coming?
I think they are primed for an imminent, synergistic, bolt-on acquisition. Think about it. They'd target something fast-growing, probably in that plant-based or clean-label protein space, something that slots right in.
And they could plug it into their system.
Immediately. Leverage their sales and marketing muscle, their R&D, their supply chain teams. This wouldn't just add another growth brand. It would likely accelerate earnings growth fast. They could integrate it efficiently, benefit from their own cost-saving efforts. It could rapidly ease any remaining margin pressure, too.
So it's not just organic growth. It's using that balance sheet for fuel injection.
Exactly. It's inorganic acceleration, funded by an under-leveraged balance sheet right in the middle of a red-hot category. That's the play. Long SGF based on imminent accretive M&A.
Okay, definitely food for thought there. And that brings us to the end of our deep dive into Simply Good Foods Q3 fiscal 2025 earnings.
Yep, we've hit the key numbers, the brand strategies, the good, and the strategically adjusted the outlook, the cost pressures, and even a potential M&A angle.
Remember, the whole point of this deep dive is to give you that shortcut, pull out the really important stuff so you're informed quickly.
And as always, please remember this discussion is purely for informational and educational purposes. It is absolutely not financial advice.
Definitely not. Always do your own homework. Talk to a qualified financial professional before making any investment decisions.
Wise words.
Thank you for joining us on the deep dive. Hopefully this gave you a clearer view of Simply Good Foods and where it fits in today's consumer world. Until next time, keep digging for those insights.